Hello everyone, welcome back. I'm Alton Bell, the founder of Bell Tax Accountants and Advisors. I'm an IRS enrolled agent, and I'm here to share with you all my entrepreneurs who have an LLC, or if you're thinking of forming an LLC, how they can be taxed. There's pros and cons when it comes to LLC. One pro about an LLC is that it's very flexible on how you can treat it from a tax perspective. The con is you gotta select the right tax structure that fits best for your business and or your lifestyle and investors. There's 4 different ways. Let's jump into it. The first and simplest way that an LLC is taxed is as a sole proprietor. It's very easy to report. It goes on your personal income tax return as a sole proprietor Schedule C form. All your income, all your expenses. Now the downfall and the con about the sole proprietorship LLC being taxed is that you pay self-employment taxes of 15.3% of your net profits before you even get to your federal income tax rate. So let's just say you made $100,000. Your first tax bill, self-employment, is 15.3%, $15,000, and now you gotta pay federal taxes on whatever your tax bracket is of that $100,000. So right away, you probably being taxed at like 30%, just 30+% just off that self-employment income. So it's very simple, it's very cost efficient, but if you get too profitable in that sole proprietorship, it can be very, very highly taxed, okay? Number 2, a partnership. If you and a partner, you want to form a partnership, you got a great business plan, you can choose to be taxed at LLC as a partnership, okay? Now the partnership has its own tax form. You file that tax return, and let's just say that the profits are $100,000. That partnership doesn't pay any taxes, but the profit share is taxed at the personal level. So if I own 70%, I get my $70,000 profit, I pay taxes on my $70,000. My partner is 30%, he pays his taxes on his 30% profit. That's pretty much how a partnership tax return works. But you still pay self-employment taxes, and you still haven't got around that. So although I got my $70,000, I'm paying self-employment tax of 15.3% on that $70,000. And then I'm paying my federal income tax rate. So that's the second way that an LLC is taxed. The third way, which is very popular for sole proprietors, is an S-Corp. If a sole proprietor gets very profitable, they like to choose S-Corp. S-Corp is neat, but let's be sure that we choose the right designation and that we go to the IRS and get approved to be taxed before S-Corp. You just can't decide to say, I will be an S-Corp this year. You have to get approval from the IRS to be recognized as an S-Corp. Now, one thing about the S-Corp, you have to have yourself on the W-2. You gotta run payroll. The IRS looks at it, how is a company running without an actual employee? So you gotta run payroll. 2, you gotta have separate books and records, and the S-Corp files its own tax return, okay? So it's very costly when it comes to maintaining the S-Corp, because you gotta have payroll service, you gotta have bookkeeping, and you gotta have a separate tax return before you even get to your personal income tax return. So that's the S-Corp. The last one that an LLC can be taxed is as a C-Corp. C-Corp is its own entity, has its books and records, has to file its own tax return, but the C-Corp pays taxes on the net profit of 21% right in that C-Corp. And you, if you're an employee of your LLC C-Corp, or you're taking dividends, you're only taxed on what you pay yourself a W-2 and the dividend distribution that you take from your C-Corp that's a LLC. Those are the 4 ways that an LLC is commonly taxed. I'm not going to get into anything beyond that, but if you like this video, make sure you like, subscribe, love, comment, and follow. Once again, if you need a tax professional, don't hesitate to reach out to me and my team at 855-TAX-BELL. Once again, it's 855-829-2355. And let's be blessed and have a great one.